Hello, everyone. Thank you for joining me this evening. I'm James, market strategist at Smart Securities. Um, Forgive me if I sound a bit weird because I'm feeling under the weather. And welcome to another episode of Talk Stock with James series. Tonight, our topic is second quarter earnings review. What's next for Tesla, Microsoft, Meta, and Alphabet? This evening topic differs slightly from our usual focus on individual stocks. Since it's earnings season, it's good to review some of the interesting companies. I know it's a bit late to discuss companies that released earnings last week, as some of the stocks may have already gone up on their earnings date, but it's okay as long as it's a good company. It's never too late to invest. Okay, I'm conducting this Talk Stock with James series every alternate Thursday, 7:30 p.m. The next one would be 17th of August. Furthermore, once the webinar concludes, we will be uploading this replay. You can access to the replay on the Talk Stock with James YouTube channel. And while you are listening to the replay, don't forget to subscribe to the YouTube channel itself. And Smart Securities will be participating in this year's Invest Fair organized by Share Investor. It will be a physical event. I will also be speaking at this event on 12th of August. Is a Saturday, and my topic is crafting a successful US portfolio with popular stocks. So come and say hello. And let me begin with disclaimer first. This presentation is presented to you for education and sharing purpose only and does not constitute to any form of advice. Past performance is not indicative of future performance. Let's talk about Tesla first. As you may have known, Tesla has always been one of my favorite companies. In the event that the earnings report does not look good in the next few quarters, I encourage you to look at the company's long-term growth potential. Long-term wise, if you like EV industry, I would say Tesla is my most favorite stock to gain exposure to EV industry. In this earnings report, there are a few key points. Firstly, profit margins is disappointing, and that's okay. If you recall for our earlier Tesla webinar in January, we anticipated that the company would test investors' tolerance for lower profit margins in the coming quarters. Basically, Tesla will continue cutting its profit margin to sell more cars to grab more market share. And Elon Musk has said it many times that Tesla will sacrifice margin to drive volume growth. The gross profit margin is now below 20%, and I think Tesla may lower it to below 15% to observe how investors react. So as expected, the second quarter earnings report shows a decline in profit margin compared to the previous quarter itself. 2 quarters ago, it was doing 23%, and last quarter is 19%. This quarter is only 18%. The gross margin also dropped from an all-time high of 29% in quarter 1 2022 to 18% in the latest quarter. The operating margin, on the other hand, also decreased significantly from about 19% in quarter 1 2022 to 9% in quarter 2 2023 itself. So however, if you were to look at the top line revenue growth itself, you are able to see that the top line revenue growth itself, right, is actually quite good. It's still double-digit growth itself. And if you were to, it's double-digit growth itself. And if you were to look at the operating income year-on-year growth itself, right, is declining. But basically, we may have seen the worst performance in Q1 2023 when it showed a negative 26% year-on-year growth. Because this quarter the decline is smaller, it's only negative 8% itself. It actually showed an improvement. So it actually suggests that the situation might be stabilizing. So all in all, if you are a Tesla investor, just remember that the profit margins for the next few quarters could look even worse. Okay, and if you were to ask me about Tesla's most important near-term goal, I would say that car deliveries number are crucial. To me, the deliveries numbers is more important than FFD and profit margin now. In a 2021 statement, Tesla actually say that over a multi-year horizon, we expect to achieve 50% average annual growth in the car deliveries itself. So if you base on 2021 guidance, basically the 2021 target is 750,000 and 2022 is 1.125 million. And so far they have hit the targets and they have been able to meet all these targets itself. However, Tesla CFO also mentioned that this year they are targeting about 1.8 million cars deliveries. So in the first half of the year, we are able to see that they achieved 889,000 deliveries, which means they need to deliver approximately 911,000 cars in the second half this year. And I believe that it can be achievable, especially considering the second half deliveries tend to be stronger than the first half historically. So I would say that Tesla car price is dynamic, but the overall trend is still cutting the car price further. So it should help Tesla sell more cars. Secondly, I would like to discuss the Superchargers briefly. Recently, investors have been quite excited about Tesla opening up its charging network to other companies like GM and Ford, which could potentially establish Tesla Superchargers as the industry standard in the United States, especially considering the fact that these three US automakers, GM, Ford, and Tesla, collectively control over 60% of the country's EV market. So it's quite a good news to Tesla investor. So investor push up Tesla share price because of the Superchargers news itself, but please don't get overly carried away with the news, because charging revenue currently is accounting for less than 9% of the Tesla total revenue and is less than 3.7% of its gross profit. Therefore, I would actually keep my focus on Tesla EV sales as they remain the primary driver of the company's financial performance. Thirdly, let's compare Tesla to other car makers in terms of revenue and operating income. In terms of revenue itself, at this moment, only Tesla reported the second quarter earnings, while many other EV makers has yet to announce their results. In absolute numbers, Lucid, Rivian, Li Auto, NIO, BYD all have smaller revenue compared to Tesla. Some BYD investors would argue that they prefer BYD because it sells more cars than Teslas and is catching up in revenue itself. It's true. While it's true, I would like to point you to the operating profit. Many of these EV makers are currently operating at a loss. For example, Rivian, Lucid, NIO, all operating at an operating loss itself. While BYD is profitable, but it's still relatively smaller in terms of the operating income compared to Tesla. This actually means that when measuring the market share based on the operating profit of all EV makers, Tesla would still have the largest market share. And in the first quarter this year, when Tesla actually cuts the profit margin to sell more cars, especially in China, the operating profit only fell by 32% quarter on quarter. In comparison, BYD operating profit fell by 48% quarter on quarter. This actually indicates that Tesla resilience in managing its operating profit despite adjusting the margin to increase the sales. So it's quite interesting to see how well BYD will perform in the last quarter when they actually release the earnings result on 28 August. It will provide further insight to the competitive landscape among all these EV makers. Okay, now let's discuss about Meta platform, formerly known as Facebook. This quarter earnings result were actually quite positive. In the latest quarter, Meta platform experienced a 11% year-on-year increase in revenue, marking it the second highest quarterly revenue in history. The advertising revenue, on the other hand, which accounts for 98% of the total revenue, also achieved the second highest quarterly revenue in the company's history. Though I do not provide the operating income figure here, it's worth noting that the operating income is the fifth highest in company history. If history serves as a guide, the fourth quarter usually tends to be the strongest quarter for Meta platforms. For example, if you were to look at the revenue quarter on quarter, basically the fourth quarter revenue is the strongest quarter itself. In terms of operating profit, it also tells you the same story. Fourth quarter tend to be the strongest quarter as well. However, the second quarter has performed better than expected, which actually raises the questions about whether the potential of Meta platforms has been underestimated. So it makes me wonder if I have misjudged the potential of Meta. Because I say that I don't like Meta, when I talked about it in the webinar last year, I was mostly neutral on Meta. The most impressive thing about Meta is the advertising revenue growth. In terms of the advertising revenue, it has a decent 11% year-on-year growth this quarter. In comparison, Google advertising revenue growth was just 3% this quarter. One of the key things I pick up from the earnings call is that Mark Zuckerberg said that AI infrastructure that he has spent billions of dollars are paying off now across ranking and recommendation systems and improving engagement and monetization. To put it simply, previously, Facebook's recommendation system heavily relied on app tracking, which actually tracked the user data from other apps and websites to deliver personalized advertisement to you. However, with the majority of the user now opting out of the app tracking, Meta has adapted his approach by introducing an AI-driven recommendation system itself. This system actually pushes AI recommended content from accounts that users do not follow previously, and it results in an increase of 7% in overall time spent on the platform. The recommendation system is known as Discovery Engine, actually helps in monetization efforts by helping users discover content they have not encountered otherwise. And according to Mark Zuckerberg, more than 20% of the content in user Facebook and Instagram feeds is now recommended by AI from sources they do not follow as a result of this AI-driven approach. the real feature has become increasingly influential and has contributed significantly to the Meta revenue. It has generated 10 billion in revenue compared to 3 billion last year. So a lot of hype has also been built around Threads, and it's only took 5 days to reach the threshold of 100 million users globally. In comparison, ChatGPT took in 100 million users in 2 months' time, while Twitter, on the other hand, had approximately only 238 million users as reported in July last year. However, I would say that social media evolution is quite hard to predict, and despite Threads' impressive growth, don't get overly excited about it. I think that what Threads is having advantage over Twitter now is that they do not charge the user like the blue tick features offered by Twitter. So naturally, there's a group of users who like to go to Threads as an alternative to Twitter. Yet in the past, Google Plus failed and Clubhouse failed, if you still remember what Clubhouse is. So even Threads enjoy some early success, I remain quite skeptical. And I'd like to briefly talk about Metaverse that Mark Zuckerberg has invested heavily in. It has been almost 2 years since he first mentioned about the concept. But the revenue generated from this investment does not seem to have improved significantly, reaching only about $276 million in the latest quarter. And in terms of operating income, Meta's Reality Labs division, which is responsible for the Metaverse project, has consistently incurred losses in many past quarters itself. The operating losses usually range from 2.8 billion to 4.3 billion during the past 7 quarters, indicating that the difficulties in achieving profitability in the Metaverse. And did I also mention that Meta expects operating losses to increase meaningfully year over year due to ongoing product development efforts in AR, VR, and more investment to further scale their ecosystem. So I would say that the venture in Metaverse doesn't really look so good at the moment. And despite my initial assumption earlier this year that advertising revenue might decline due to a worsening economic outlook, Meta's advertising revenue seems to be holding up well. However, the app tracking transparency feature introduced by Apple has caused a significant damage on Meta. To address this, Meta appears to be focusing on AI content recommendations as a potential replacement for app tracking to improve the efficiency in pushing advertisement. And the year-to-date return for Meta is around 161%, making it the second highest stock this year after Nvidia, if you compare it among all the big tech stocks itself. Nvidia returned 203% year-to-date. So considering the surge in Meta's share price, I think the share price has gone up too much. So I maintain a neutral view on Meta. I would say that life is short, money is scarce. I think there's better choice than Meta. Okay, now let's talk about Google. Google's recent earnings results were indeed impressive. The earnings result exceeded market expectation in many key metrics, including revenue, earning per share, YouTube advertisement, Google Cloud, and traffic acquisition costs itself. Interestingly, Google emphasis on AI is evident. Google mentioned the word AI 90 times during the earnings call. This number actually surpasses the mention of AI by Microsoft 72 times, Meta 19 times in their respective earnings calls itself. I think Google CEO knows the secret sauce of pumping up the share price, which is to mention AI as many times as possible in your earnings call. Let's look at revenue first. In the latest quarter, Google revenue increased by 7%, which is a positive sign for the company. About 89% of the revenue comes from Google service revenue, of which advertising revenue accounts for 78% of the total revenue. However, the growth in advertising revenue was just 3.3% year-on-year in the latest quarter, which could be seen as somewhat disappointing. But this 3% growth is a notable improvement compared to the previous 2 quarters itself, which experienced negative growth rate of negative 3% and negative 0.2%. So the positive 3% year-on-year growth that we witnessed this quarter actually suggests that we may have seen the advertising revenue bottoming out. Especially everyone is talking about soft landing, but not hard landing in US. And Google search accounts for 57% of the total revenue. There are worries about Google search engine will be displaced by Microsoft Bing search engine due to ChatGPT. But looking at the Google search revenue, it does not seem so concerning for now. Especially Microsoft say that it's expecting mid to high single-digit growth for Bing search in the next quarter. So it's not really that high. YouTube advertising revenue increased by 4.4%, but I doubt that this growth will significantly contribute to future revenue given the tough competition from other social media apps like TikTok. Moreover, YouTube's practice of inserting 2 to 3 advertisement at the beginning of the video itself, right, might negatively impact user satisfaction. And I don't believe they can add a lot more advertisement without furthering affecting this user experience itself. Google other revenue, which accounts for 10% of the total revenue, increased by 24%. Google other revenue include Google Play revenue, Google hardware like the Google Pixel phone, and the YouTube Premium subscription program. The 24% growth in this segment might be contributed to the user opting for user premium to avoid the frustrating advertisement itself. And other than that, the launch of the Pixel phone 7a also partly helps boost the revenue in this segment. But the impact of the Google Pixel phone sales, right, will be limited in future because I don't see a favorable outlook for Google hardware, including Pixel phones. Because if you browse through the sales, the Pixel phone sales on e-commerce platform like Lazada and Shopee is really lackluster. And I visit Courts Singapore and Orchard almost every weekend. When I walk past the Google store inside Courts itself, right, it's basically empty. Almost every time when I walk past. So I think Google is still not the expert in making the hardware. So what about YouTube TV? YouTube TV is part of the Google other revenue. What is YouTube TV? YouTube TV is a TV streaming service that lets you watch live TV from ABC, CBS, Fox, NBC, and other popular cable networks, it will cost you $73 per month. We do not know that because we don't live in US, but in US, it is offering $73 per month. I think if YouTube TV has gotten big enough, Google would like to disclose more. So it's something to look out for. But after all, you should focus on Google advertising revenue when deciding to invest or not. The operating income grew faster at 12% year on year. Other than that, we could also see that Google cloud revenue increased by about 28%. In comparison, Microsoft Azure growth is 26% year on year. And this is the second consecutive quarter that Google Cloud has generated a positive operating income itself. If you compare to the same quarter last year, it was doing negative 858 million. So it turned positive 395 million this quarter. It actually marks a significant improvement. More importantly, if you look at last quarter, it was doing 191 million. Now it has doubled the size to 395 million. The positive trend itself, right, actually suggests to all of us that once it becomes profitable, the growth potential could be substantial due to operating leverage. As you might recall, I mentioned last year that I believe Google Cloud could be profitable in 2023. So considering all this development, I believe sooner or later, analysts will reassess and potentially upgrade their valuation on Google Cloud business. So all in all, I don't think that is a major concern for Google as of now. I believe that if you like advertising business, Google is still the best choice out there, unless ByteDance is listed. My first choice is still Google if you want to gain some advertising revenue itself. But also bear in mind that US and global advertising revenue growth is mid to high single digit this year and next year. So the growth for advertising business is still quite slow. So I guess this is why Google needs to mention AI so many times during this earnings calls. Overall, I don't think there should be, I believe that there should not be a major concern for Google in the next few quarters. And finally, let's talk about Microsoft. Basically, Google AI has been a few steps behind the competition. So if you like the concept of generative AI and you believe that generative AI has a lot more potential, Microsoft is currently the best software stock to gain exposure. This quarterly earnings report was not bad. The top line revenue growth is, let me take a closer look, is 8%, suggesting that the 1.9% that we seen 2 quarters ago was probably the worst revenue growth itself. Operating income grew by 18% year on year, which is quite impressive. One key note is that both productivity and intelligent cloud revenue are at their all-time high. But personal computing are not doing so well. Let's talk about more personal computing first. Personal computing includes Windows operating system, device revenue such as Surface, laptop, gaming Xbox, and search engine, Bing, and advertising revenue also included under the personal computing itself. So overall, the PC sales is not doing well. That's why you should not expect much from this entire segment. According to Gartner, the PC sales in second quarter fell by 16% year on year. And now it's post-COVID, so it's natural to see declining PC sales. The most important thing is the growth of the search and news advertisement itself. Analysts are expecting good growth due to ChatGPT on Bing. However, the Bing search revenue and advertising revenue only grew by 8% year on year. In comparison, Google search advertising revenue grew by 3.3% during the same quarter. Microsoft is only expecting mid to high single-digit growth in the next quarter, which is quite disappointing. Overall, I am seeing the overall declining trend in the search advertising revenue. For example, if you were to look at quarter 4, 2021, the advertising growth was about 49%, whereas in the latest quarter, it was only 8%. It actually suggests to you that this should be an industry-wide problem, and ChatGPT itself probably helped slow down the decline. In other words, without ChatGPT, the number could be worse than 8%. My thinking is that generative AI will not help Microsoft steal a significant market share from Google search, as Google's ecosystem is complete. Bing will not displace Google search because Google possesses more users and the user data itself to help generate better search results. The main appeal itself of generative AI is the Copilot, which will help Microsoft generate more revenue. Copilot is priced at $30 per month to commercial user. It integrates ChatGPT-like functionality into the products. The main attractiveness of generative AI is the Copilot that will help Microsoft generate more revenue. Since it's offering $30 a month to user, what it actually helps is that it will help you write the email better. It will help you generate some report better itself. Basically, is to increase your office productivity through the software suite itself. So far, I would say that this is the best monetization avenue for generative AI for Microsoft. It seems like Microsoft Copilot will be more successful than Google Duet itself. The productivity and business processes accounts for about 32% of total revenue, and the revenue of Copilot will be included here. The Copilot is, again, I like to repeat that it's open up to commercial customers. But what is the percentage of commercial revenue in productivity and business processes in Microsoft? No one exactly knows. My estimation is maybe 70% to 80%. And according to a report from Macquarie Equity Research, Copilot could add roughly 14 billion to the company's top line revenue in the first full year itself, assuming 10% of the Microsoft existing corporate user sign on for that. So it's quite promising. Lastly, let's talk about Azure, the intelligent cloud itself. If we were to look at Azure and other cloud services revenue grew by about 26% year over year. The guidance for next quarter is 25 to 26%. But since it's below market expectation, I believe this is why Google share price fell a bit on the earnings day. And I think it's okay. All in all, I would say that the AI bubble is not over yet. The Copilot program may provide a bump in the revenue in the next few quarters. It's good if the general stock market falls on yesterday news about the Finch downgrade on the US bond. I would say that it will provide us investors better entry price for all these technology stocks in conclusion, other than Meta, I would say that I like the other three tech stocks, namely Google, Tesla, and Microsoft. If you were to ask me to rank my preference, it would be Tesla first, then Microsoft and Google. And I shall end my presentation here. Please subscribe to the YouTube channel. And let's proceed to the Q&A sessions. If you have any question, please type a question in the Q&A box. I will try to answer all your questions. Okay, let's go to the first question. What about Xiaopeng? Yeah, I don't quite like Xiaopeng. I think if you are targeting, if you are pushing out low-end cars to the consumer itself, right, you don't have a good branding like Xiaomi itself. So it's actually tough to survive if Tesla start cutting the profit margin, BYD start cutting the profit margin. So Xiaopeng need to cut further. So this is why, if you were to look at the operating margin, if I'm not mistaken, it's negative itself, and the gross profit margin is low single digit, if I'm not mistaken. So I don't believe that Xiaopeng actually has a good future itself. It might have a going concern, but let's see. Okay, what is the reason to buy Microsoft again? Sorry, just now line wasn't good. I would say that if you really want to ride on the AI wave, I would probably bet more on Microsoft to succeed in the generative AI than Google to succeed in the generative AI itself, because there is a lot of use case for Microsoft generative AI. So basically, you just embed all the co-pilot in your current software itself, be it the cloud computing, be it the Office suite, be it the CRM system. You can just embed all the co-pilot, and then and people will probably pay for it and use it. So I see good future for that itself. But again, for Microsoft case is that you will incur a lot of capex, and most of the capex itself, because you need to buy a lot of chips. So all this capex itself, right, will go to NVIDIA. So if you were to ask me, I would say that NVIDIA stands to gain most of the advantage of this AI bubble initially. It actually depends on how many users, commercial user, Microsoft could garner going forward. So basically, I would say that along the way, as long as they disclose more numbers, we would know that how much they actually gain from this co-pilot itself. As for Google, it also, okay, because Google Bard AI, which is the Google Duet itself, right, they haven't announced the pricing yet. So we should wait for it to announce the pricing and see how the market react to that, and to see whether this Google Duet itself really garner a lot of interest or not. Otherwise, right, I would say that at this moment, if you really like the generative AI story and you want to have a software company to invest, Microsoft is my best choice itself to gain exposure. Okay, why Tesla is a must-buy share? Okay, again, it actually depends on your risk profile, because it actually depends on whether you believe in the EV industry story itself. Personally, I like the growth story of the EV industry. So this is why I would say that if you want to gain some exposure into EV industry, Tesla is still your best choice. And again, people will say to me that, oh, why not Li Auto, why not Rivian, why not BYD? Again, my answer to that is always why you want to find the next Tesla when there is already a Tesla in the market and is probably 20 or 30% off this all-time high. So I would say that Tesla do indeed look attractive in long term itself. And again, probably one keynote I would like you to understand is that, okay, the profit margin, the declining profit margin that you are seeing now, right, is not important to me. Indeed, I think that Tesla should cut down the profit margin to continue to grab more market share. The lost profit margin, right, in future, you can gain elsewhere through the SaaS system, like the software, the co-pilot machine, or the FSD system itself. So in future, Tesla will rely on this software revenue to garner a significant number of the profit margin. This is basically it's going the same route of Apple. Apple sell a lot of hardware in the start, but later on, right, the software revenue actually contribute to a significant revenue source and a higher profit margin for Apple as of now. So I believe this is what Tesla will go through in the future, because hardware sales cannot be always 50% each year. It will decline. But later on in the future, you will surely rely on software revenue to bump up your profit margin, to bump up your operating profit itself. And again, I believe that Tesla FSD system is probably the best as of now. Okay, how can you rank a business Tesla that needs to cut their price and profit margin to gain market share ahead of Microsoft and Google? Okay, I would say that I come from an aggressive investor point of view. If I would like to share my humble opinion with you, I would say the growth for Tesla could be more exciting than Microsoft and Google as of now, because you could basically see that EV industry growth is huge, and a lot of government policy, right, are quite favorable to actually push the EV industry itself. So this is why I like the industry that Tesla is in now. And basically, right, again, I would say that probably the share price, if you were to look at some valuations report, it's actually shoot up, it's above the fair value. But again, I would say that a lot of analysts may have not yet featured in the success of the FSD. So it also depends on you whether you believe Tesla will successfully created FSD's autonomous driving system itself. Otherwise, right, I would say that probably this share price as of now is quite fair. It's not overvalued, but it's quite fair at the moment. I do not have great hope on FFD to succeed this year, or maybe not even next year, but maybe in 2 to 3 years' time. That is my probably current predictions at the moment. So in future, right, if SSD really succeed, they will have a re-rating itself. Okay. So how about TSM? TSM also producing chips for NVIDIA, right? Okay. Okay, this is a tough question, and it's a very interesting question. Okay, unfortunately, I have not gone through the TSM earnings report fully yet, but I briefly take a look at it. It's not doing so good as many analysts or investors are expecting itself. Yes, TSM is producing chip for NVIDIA, so naturally the relationship is that if NVIDIA has a lot of order, they would like TSM to produce a lot of chips for them, but it doesn't reflect on TSM earnings. It actually confused a lot of investors and analysts. No one have a good answer for that. If I were to guess, I would say that maybe the chip demand itself, right, is overrated. And why NVIDIA can have such a substantial revenue growth itself, right, is because they actually take out the inventory and sell it to the customer at a higher profit margin. So this is why you see good profit margin, you see a good top line revenue growth itself. But it could only be good for 1 or 2 or 3 quarters itself. Later on, after they exhaust all NVIDIA, after they exhaust all the inventory, then I would not say that the revenue growth itself, right, is sustainable. Okay, so there is a bit of confusing signal here. I would say that overall, TSM revenue also not only coming from chips from NVIDIA, it also comes from PC sales, it also comes from the demand for Apple itself, and phone demand is declining, PC sales is declining. So this is also explained to you why TSM revenue is not doing so good. Overall, I would say that to really look at TSM, you should look at the industry cycle, and it does not seem like the industry cycle has bottoming out yet. Despite TSM management always say that, oh, yeah, actually bottoming out in second half of this year. I don't quite believe them at this moment. But again, TSM is also one of my favorite company. If you really like the semiconductor industry itself, right? This is one of the you simply cannot avoid TSM, just to put it that way. Okay, Johnson is a very good question. In my opinion, what is the fair value of Microsoft, Google, and Tesla and Meta? Okay, I don't have an answer for you now. Why not I do some discounted cash flow model and I put it up the answer on the YouTube channel. I'm so sorry, I don't have the answer now. And when I put up the discounted cash flow models, right, let me also put down the consensus target price from Bloomberg itself. So but again, right, sometimes fair value is just fair value affected by many numbers itself. So for example, if you were to use discounted cash flow model and you see a surge in the 10-year bond yield last night itself, so do you want to adjust your discount rate and to adjust your fair value? So I would say that sometimes, right, in fair value is just a guide lah. It's just a guide. Yeah. So I hope I answered that, and I'll remember to put up the target price on the YouTube channel itself. Okay. So there are many good questions tonight. I hope I answer all of them. I wish you a good night, good evening, happy trading, happy investment. Okay, probably one last note is that what is the worst case scenario if market were to decline? Okay, as I mentioned many months ago, the worst case scenario for me is 3,600 for S&P 500. So if bears was to push down the S&P 500, right, 3,600 would be my worst case scenario. Otherwise, I would say that typically when you look at second half average drawdown, it would be negative 6%. Why I say negative 6%? Because if you were to look at all the S&P return for the second half in the years that S&P returned negatively last year, and it returned more than 10% in the first half, then in the second half, it will return typically, I think, maybe 12%, but encounter a drawdown on negative 6% itself. So I would say that if there's a drawdown of 6%, probably some bulls, based on some data size, they would be interested to invest already. But again, this is just a guide. Okay, thank you so much. Happy trading. I would like to see you on InvestFair. Just come and say hello. Thank you.